Reality is this, not everyone wins in this real estate game. While there are some winners, there are also unfortunately losers, even as we see new condos breaking through new PSF. Now, why is that so? A big part of it is due to a simple fact. No one can time the market perfectly. So in this video, I'm going to share with you how you can buy with less risk by going through these 7 beneficial checkpoints. Now, if you're a single home buyer buying your first property, then this video is for you because you know that one wrong move hurts even more. Or if you're a buyer already in the market for a while, you have already started viewing, shortlisting, you just don't know which one to pick first, then this video is for you as well. So starting with identifying the macro growth opportunities. So what you want to do is first identify what is a benchmark pricing so that you can benchmark any of the projects that you're analyzing against this. What I will do is to take a basket of projects that is close to the MRT stations in the outskirts of Singapore, and that will give me an idea what are those transacted prices, what are the transacted rents. That will give me the basis for comparison, because if I find a property that is of a similar price to all these outskirts project that is closer to center, that offers opportunity. Likewise, if I find a project that is in the outskirts region of Singapore that is way more expensive than those that is closer to MRT, then that also tells me something that I can keep in view first. So when I sort by the PSF, you already can tell which areas are potentially undervalued, and that could be the area that you want to zoom into first. And if you're buying for rental, you can also use the same idea to have a sense of what the rental rates are like in the outskirts of Singapore around the MRT station to give you a basis for comparison. Now, once you have done this benchmark pricing and have identified the zones with better growth, you can now zoom into these zones first. And of course, these zones would have varying sort of capital appreciation, growth potential, master plan. So this is where we want to dive deeper. So the first thing I'll look at is the exit audience and the competition in that zone itself. Because if I buy today, I want to think of myself selling 4 to 5 years later. I want to know that number one, there is a healthy buyer pool there. Number two, the buyer pool there is able to afford the price I'm going to be asking at. Number three, who are my fellow competitors when I want to sell down the road? Because stiffer competition means I will have to wait longer, means opportunity cost for me to pivot into another home. So technically speaking, high supply area also means a longer waiting time unless your property has a unique USP that stands out from the rest. Otherwise, from a risk management point of view, typically higher competition as compared to an area that has lower competition, there's more opportunity cost. So in this example, other than looking at the projects within the zone, I will also look at the prices close to MRT, because that will also tell me within that zone itself, am I overpaying for a certain location, or are there potentially hidden opportunities for projects that's close to MRT? Secondly, it also informs me of the competition, that if I buy in this area that's further from the MRT, down the road, projects that's closer to MRT will become an even stiffer competition. So I need to make sure that my entry price is a gap, so that when I sell in future, that gap makes sense for my future buyers as well. Next, still in point 2, I will look at the master plan to see what is the upcoming growth in the area and transformation, and whether or not that transformation is already taking place or it is something that I have to wait 4 to 5 years later. Potentially that transformation may benefit me or may not be something that I could wait out. So for example, in this case, we were analyzing the area and realized that there's going to be a future MRT. There's also going to be landed homes in that area that could potentially be a pool of buyers for right sizes. There are also future plots there where essentially there may be new condos that will be built setting a new benchmark price, or new HDBs that will be built where either the owners or the relatives of the owners who want to stay in the area as well, being familiar, will want to consider upgrading to the condo in those areas. So in short, having future residential plots is a good point, because it will either drive up benchmark pricing if it is a new condo, or it will provide you with even more buyer pool in time to come. So still within that zone itself, I want to make sure I'm comparing with projects that is closer to MRT to make sure that there is a disparity. If I'm further from MRT, I'm not paying a price that's closer, and of course that disparity gap cannot be too near. So likewise, I will take a look at what has already been transacted around the MRT. Let's say for example, you're finding a 3-bedder, 900 to 1000 odd square feet. If you're looking at a 2-bed, 2-bath, about 800 to 900 square feet, at least that would give me an idea what are transacted prices there, because they will then become the future sellers and they will then become part of my competition when I want to sell. So that's one. Number two, I want to make sure that my entry price today, if I'm further from MRT, is not too close to the transacted prices over there. So likewise, when I sort by PSF, I already know which are the projects that potentially potentially could be my competition, and then I will look at what are the asking prices now to sort of see whether or not are there opportunities there that I can consider that's within my investment figures. Now, if you are renting out, then you also want to look at the rental demand and supply. What I will do is I will look at not just the transacted rent, I will also look at the asking rent in the area and then take a more conservative figure. So assuming there are some vacancy period, I'll usually use, instead of 12 months, I use 10 months to calculate the annual rent. I calculate the yield, and then I see whether is it still something that I can consider or does it still make sense. And again, I need to know that if I'm renting out today at this current location, if the rent is going to be too close to those that's already asking around the MRT, if I were to adjust my rental on this side to make it more competitive, does the yield still make sense for me? Is the demand high in the area? Is the competition stiff there even when I'm renting out? Next, in that zone itself, I also want to see that there are good schools within that 1 km, because essentially you want to own something that families can consider, especially if you are looking at a smaller unit like a 2-bed 2-bath. You want to cater to a small family with maybe 1 kid looking to enroll into the school. You want to make sure that this will be a buyer pool to at least give you a safety net. If you're within 1 km of a good school especially, there will be demand. And of course, if you can stretch your dollar a little bit more, buy a bigger home, then you will attract even more family profiles, helping you to manage your risk better in terms of future sale and future demand. Now, the third beneficial checkpoint would be to shortlist suitable projects and listings and prioritize those that is number 1, within my investment budget, number 2, asking price is reasonable, and this will be the units that I want to be able to take action first. Bearing in mind that well-priced units tend to move very quickly, so you also want to prioritize your time and energy and effort to look at all these units first. So firstly, once I've zoomed into the zones, I will look at the project and zoom into units that are well priced. I will arrange to view them first. So before I head down, I'll have a look at the asking price, I'll have a sense of what is the closing price, then compare it with what has already been transacted in the project. If it's within 5%, it is well priced. Why 5%? Typically, you need to cater for the price increase when you are hunting for a home, to make sure that you're not too conservative until you are outpriced or outbidded by the other buyers, potentially losing a good unit. I also take a look at the transacted rent and the asking rent. Is it going to be easy to rent? What are the potential obstacles? Is there going to be competition? That is assuming you're buying it for investment. So after I have shortlisted the units, and then I will look at the site plan to see what are the kind of facing that I cannot change, because bearing in mind, you can change the renovation style inside your home, you cannot change your facing, and that facing could be a stumbling block in future when you want to sell, or it could also help you. So we want to make sure we want to position ourselves, stack the odds in our favor. Whatever facing that this unit is getting, I want to try to avoid as many adverse facing as I can. So still at point 3, I will also look at the profitability of the project. I will take a look at what is the profitable versus non-profitable transaction. Definitely I want to see way a lot more profitability. So what I'll do is I will also sort the profits, looking at what is the top profit that the seller has made, how many years did they hold, and that will also tell me the yield. 6 to 7% would be great because you can beat the inflation. Next, I will take a look at layout. If this is your pivot home, meaning to say that you're intending to sell after 7 to 8 years or after 4 years, after the stamp duty clears, then you want to make sure that you want to buy a layout type that is more mass market, that is more acceptable for the buyer pool, because essentially you want to widen your buyer pool so that when you want to sell, there are more buyers who will consider your unit. So when I take a look at the layout, I will then ask myself, are there potentially any areas of the layout that could be a stumbling block because it is just one of a kind in the area, or it is very common to find in the area, then I know that I don't have to worry. So essentially you want to own a property that will give you as little obstacles or objections from your future buyers. That will then help you to reduce the waiting time to find a buyer and be able to increase the resale value because there is demand. The fourth checkpoint is to then zoom into the project to compare the last transacted prices in terms of the stack facing, in terms of the floor level, in terms of the size, and also compare it with the bank valuation. So bearing in mind, a lot of this data does not tell you the condition of a unit. It doesn't tell you whether or not there's extension. It doesn't tell you all the terms involved. So when you look at this data, you also use it as part of the multi-angle approach that we are talking about right here to give you a more holistic understanding. So in this case, I will look at the current asking price and compare it with the past transacted, and I'll take note of where it is facing. Is it comparable? Preferable, if possible, within 5% of the recent transacted PSF and price. So essentially what you want to do here is to make sure that you are buying at a market value with a buffer of 5% and making sure that you're not overpaying for something that has perhaps a not so ideal facing as compared to one that has really been done at a premium facing. Again, you want to position yourself, stack the odds in your favor so that when you want to sell in future, you want to reduce as many obstacles as possible. Now number 5, once the unit has been shortlisted, I will then compare it with the new launches in that area. So the thought process is to make sure that if the PSF of the resale and the new launch is very close, then I might as well buy the new launch, being brand new, being a longer lease tenure, if I'm able to wait for a new launch. So again, it helps me to understand whether or not this resale that I'm buying has a gap to the new launch. So this is what I will do. I will compare the new launches in the area, compare it with the resale that I'm considering. Now of course, they are all built at different years, so I will do a lease reset, assume that all 3 are torn down and built up again. What I will do is I'll take the current PSF, I divide it by the remaining years, multiply it back to 99 years. That will give me sort of a comparable benchmark in terms of PSF. The new launch and the resale at least has more than a 5% gap. If it's more than 10%, it's great. It means that the pricing is not too close. Once I clear the PSF, I will multiply it by the size to look at the price. I also want to see that the resale price and the new launch price has at least a 5% gap, if not a 10% gap or more, which is best. There could also be instances where the PSF is more than 5%, which is very common because nowadays, with the harmonization in place, especially with developers building smaller sizes, the PSF might increase. So you also want to see that the PSF clears the first cut, the price can also clear the second cut. Okay, so once it's within my benchmark of resale and new launch at a gap of 5% or 10%, then I will arrange to view that unit. Now step number 6, once the unit is shortlisted, I will take a closer look to project whether or not my future buyers have the appetite. The thought process is to make sure I buy something that my future buyers can afford or the demand will continue to grow. I will take a look at what is already asking in that area, not just for this particular project, but all the neighboring projects as well as those projects that's closer to MRT. I will ask myself, for this current asking price, assuming this would be the closing price, is it already a price that has already been transacted in the area? So if it has already been accepted and transacted and within the asking prices of the area, then I know that everyone in the area will have the same mentality as me. All the sellers there will be aligned together to sell at definitely a PSF that's higher than what we have bought today. And in that area, if I see that the project that's closer to MRT is asking at a way higher disparity, I know that number 1, I am already not overpaying because my location further from MRT is not similar to those that's near the MRT. That gives me a gap. Number 2, with that higher price, it also means that buyers who buy that project, when they want to sell in future, they're going to ask for even higher. So it will make my project seem of a good disparity. There is still reason for buyers to consider my project. And I also know that in that area, such prices have already been accepted and transacted. I'll also take a look at the projects in the area surrounding the unit that I've just shortlisted, making sure that the projects have more profitable transactions than non-profitable. I want to see upward trend growth graphs. The projects there have a propensity for continual upward trend. The chances are higher. I am in a profitable zone. So once the unit is shortlisted, I will do one last check. Whatever price I'm entering today, have I already fully optimized it? For this investment figures I'm willing to pump in, can I find somewhere that is closer to MRT, something that's bigger size, something that's closer to town? That will then inform me that the decision that I make today is the most optimized before I pull the trigger. So these are the 7 beneficial checkpoints to stack the odds in your favor, but that you are well positioned to enjoy greater profits. So if you would like a PDF of these 7 checkpoints, thanks for watching. And if you have a budget of between 1.5 mil to 2 mil thinking about what would be a good option to buy, then you definitely want to check out this next video where I share with you what the recent profitable transactions have been telling us.